has brought us here is actually the effort we, as a country, are trying to do in the last few years since the mandate of our government, the Ministry of Finance, and me as a Minister of Finance put development of the capital markets as one of the core priorities of our government, which hasn't been really the case in the years or actually decades before that. So we worked hard to put this issue back on the agenda because, of course, we know that only strong and well-functioning capital markets are essential for growth, innovation, and long-term prosperity. But as Tina mentioned, we will first turn to Europe and address one of the most pressing economic questions for the European Union, which is how to build deeper, more connected capital markets that truly serve our economies and citizens. So the questions before us are clear. How do we overcome the fragmentation of EU capital markets? How do we accelerate progress? And how do we make Europe's markets more attractive to investors, both here at home and also worldwide? So I'll start with Madam Commissioner, dear Maria. After a decade of discussions around the Capital Markets Union, progress is not as fast as we would like, and if I may say, it's slower and that it should be, and the capital markets in Europe still remain fragmented. Why has the EU struggled to deliver meaningful integration of the capital markets?
Thank you very much, Minister. First, I'd like to thank you for the invitation to be here today and participate in this conference. Well, the Capital Markets Union project is indeed over a decade long. I've been engaged since the very beginning, but we are now in this commission taking a different approach. So we are talking about the Savings and Investments Union, which is a more holistic concept. So we are looking at whole the financial ecosystem. We are looking at banks, but we are looking also at capital markets. We are looking at the new players, the innovative companies coming into this space, and it is very much a citizen-centric approach. We are worried to give our citizens the opportunities and the incentives to get higher returns from the high level of savings, and also to address longer-term challenges like the pension challenge, given our aging society. It's an holistic view. But to your question specifically, why haven't we progressed? I would argue that the main problem is that we thought, and maybe some still think, that we can make each capital market in each member state a success on its own. And the vision that we would like to share and that we would like to implement is actually that the success of each capital market should be built on the success of all the capital markets. Because the way we see this is building a model in Europe which is not copying any other model. It is tailored to how we are. And we are diverse. But we should also be united. And that is the focus that we should have. So it's about reducing fragmentation. It's about understanding that what is good for Europe as a whole in financial markets, it's also good for each member state. So it's eliminating protectionism, it's integrating capital markets, it's making sure that supervision is coherent, consistent, that the same question gets the same answer wherever you ask it in Europe. There are tremendous opportunities to be leveraged that can benefit every citizen and every business in Europe. And the smaller markets, by investing in themselves and becoming more dynamic, if they also push for this further integration, then they will be critical part of how we build a coherent and integrated European capital market. Because we talk about European capital market, but there's no such thing. There are 27 capital markets. And all the resources we have kept separate in 27 different pockets will simply not do the trick. So we need to integrate, we need to think more European, because actually that is what is best for each single member state. It's about us having a vision and working together, top down with the proposals coming from the Commission, but also bottom up with every stakeholder in society of the different member states. I think now with the political momentum and the understanding of how important that is, we have a real chance to make it happen. Not the old capital markets union concept, but this broader vision of an integrated financial ecosystem.
Thank you very much. Let's turn now to a member state that has been very active on trying to connect markets of Central and Eastern Europe. As you probably know, just recently 8 countries signed a memorandum on joint work on connecting the capital markets across Central and Eastern Europe. So Marko, from your perspective, what are the main barriers that member states face when trying to integrate the national capital markets with the wider European framework? And how can initiative like this memorandum I just mentioned accelerate the process and deliver some tangible benefits for investors, citizens, and companies in the region?
Thank you very much, Klemen. Thank you for inviting me, and thanks for organizing this event. I think it's really important to talk about everything that we do at EU level, and especially us, the Ministers of Finance, are quite active on several different fields, capital markets being only one of those. You know that the discussions that we have are quite extensive, and they took some time, but I really see the progress in what we are doing. In terms of barriers, I would say that there are 3 different obstacles, so to say, towards really faster integration in this broader sense. The first one is structural, the second one would be, I would say, historical, and the third one cultural. So talking about structural obstacles, it is definitely everything that we cover in our meetings, being the differences in legislation, be it corporate law, the insolvency law, different institutional setup. So this is really something that influences the decisions, and whenever we try to reach consensus in this respect, this has to be taken into account. And I fully agree with what Madam Commissioner has said. We should not be focused on eliminating all those small capital markets, but try to provide a setup that would allow them to work as a single market in this sense. So we can have 27 different entry points to the broader regional or European Union market. When we talk about historical obstacles, it is definitely the thing that in Croatia, but also Slovenia and other countries in the neighborhood, we historically have the financial systems that are bank-centric. So people hold a lot of money on bank deposits. I can tell you that, for example, for Croatia, the financial assets of households is estimated to 100 billion euros. So it's more than Croatian GDP. Around 22% is invested in equity. So if we could turn only 2% of that annually to the stock exchange market, we would already achieve a significant step forward. And then talking about cultural things, it's also the language barriers, sometimes the legislation that has to be aligned and also taking into account different historical but cultural backgrounds. And also the level of financial literacy. So in certain countries, if financial literacy is very well developed, people know what the treasury bills are, what the government bonds are, how to invest in them, what it means for them. And I can tell you that from Croatian perspective, this is something that we really needed to take care of. This is the reason why we have put a lot of effort, especially in our strategic framework for capital markets development, on financial literacy as well. I know that Slovenia does the same, and we are really trying to explain how important it is for people to invest on the stock exchange. The stock exchange, it's not just a place for an exchange of financial instruments. It's also a place where innovative firms find financing, where some companies find long-term financing sources. So it really boosts the investments, the innovation, but also provides a place where people can take care of their savings. The Croatian experience tells that when we decided to put more effort on financial literacy, but also provided more innovative, for us innovative at that time, instruments on the market, I'm talking about retail government bond and treasury bills that we did not have 3 years ago, we have successfully transformed almost 10% of our public debt, which is now being retail held. We had 16 issuances of government bonds and treasury bills, which shows that really the potential is there, but people need some education in this sense. So I think that we'll have the opportunity to discuss more about the strategic framework in this sense. I can tell you that this is the first time that we are having such a document, and it's fully aligned with countries in the neighborhood do, and especially fully aligned with the EU agenda on a broader level.
Thank you, Marko. And now a perspective from the country that is a leader in infrastructure development and sustainability index. Jürgen, Estonia is a small but digitally advanced economy. What has Estonia did differently in developing its capital markets, and what lessons could larger members learn from Estonia?
Thank you for inviting me, and thank you for those compliments. Normally, the smallest fragment in a fragmented picture shouldn't be an example, but this invitation shows that there are positive reasons here as well. And Estonia really has some significant success stories, and I think some of those stories can be explained. Some maybe are just have happened, but according to some reports, Estonia has raised the biggest amount of venture capital per GDP among, I think, the whole world. I may exaggerate, but papers told me that recently, and also we have the biggest number of unicorns. I think it's 10 already, or 11, which is for small countries very good result. But this is not, of course, a competition with other countries. It's a result of, I think, some strategic decisions in the past. Since 90s, I think already, we can say that we took the orientation to digitalization, where we are good in finance, in digital services in general. As a result, we have a strong technological sector, and of course we have had very smart people, and we Estonian startup community consists of them, and they are really very good as far as I can judge. And one of the proof is that we have been able to raise that big amount of of risk capital as a result. What are the policies behind it? One, of course, is the strategic investment in IT sector, which government itself has made, and there has also been some funds, state funds available for that community, and that support has played role, I'm sure. And the general culture of it is very open, so we have had to overcome all these barriers. We have, our venture capital has become very international. We have investment platforms designed in Estonia which can acquire capital all over Europe, and this is the picture, I think. And of course, there are certain risks, but we are also good at cyber defense. Part of it is because of general security reasons as well, thanks to Russia, who attacked us. The first major cyber attack against the country was against Estonia in 2007, and we are like a lesson to the rest of free world how to build up the defense, and of course we cooperate in this sense as well. Thank you.
Thank you, Jürgen. And let's finally hear the research and analytical view. Jeromin, looking at the big picture with structural factors, which structural factors most hold back the development of a single capital market, and how can European institutions and member states tackle them together?
Thank you, Klemen, and thank you so much for inviting me. It's really wonderful to be here and to have you back as members of Bruegel. So Slovenia was a member of Bruegel until 2012, and in some sense you were a victim of a capital market dysfunction. So it is very appropriate that we are here together again talking about the improvements of capital markets. So the first point I want to make is that, like you said at the beginning, Klemen, and like several of my co-panelists have said, there is a lot you can do at the national level, right? Before we talk about integration, capital markets work much better in some countries than in others. The Scandinavians are an example to most of us. Estonia is going down the same path. You are hopefully going down the same path, and so is Croatia. But ultimately, we will need that integration because we need it for scale, we need it for mobility of entrepreneurs who want to, break out of the local market, particularly if it's a small one, and go for the European market. So I think the structural impediments are many, but I would put them in two categories. The one is just the classic structural impediment to any form of European integration, which is that there is a trade-off between efficiency and common benefits and national control. And there are many groups and constituencies that are interested in national sovereignty, and sometimes for good reasons, sometimes for less good reasons. So there are obviously private sector or regulated special interests. There are the interests of agencies who do not want to give up power. Sometimes capital markets or something like the security exchange is a national symbol that you don't want to give up. But then there is the one that I have the most sympathies for is that some European countries really rely on a specific comparative advantage or an approach to capital markets for their national growth models, right? And so for these countries, it is really very scary to give up control because their entire approach to how they have grown might be at risk. And so that one we really have to take very seriously and find a solution for those countries. Because these are at the same time, like in the case of Ireland, and I'm very sorry that Pascal is not here, these are the most pro-European countries in other respects. So they're clearly conflicted. We must find a solution for them. The other fundamental set of reasons why it's been so difficult is because the functioning of capital markets and the integration of capital markets is related to the functioning of so many other aspects of the institutional and policy setup, which have primary reasons that have nothing to do with capital markets. So this is about pension systems, it's about corporate law, it's about insolvency law, it's about taxation, it's about housing markets. So you cannot very easily go to a national constituency and say, let's have a radical pension reform because we want to do capital market integration. And they'll tell you, are crazy? You know, pension reform is there for the pensioners. And so we have this universal problem that, you know, capital markets are like the tail that's wagging the dog. And the dog is almost everything else in society that goes very deeply into national social models and to fiscal sovereignty. And so this is very hard to do. And so how do we get out of this dilemma? So there are, I think, two answers. One is, you know, you chip away gradually at many aspects of the problem. And so this is how I interpret the European Commission's agenda with their, I think, 22 or so action points. The other one is, I think you go for just a few potentially transformational reforms and you focus on them and you pick them well. You pick them in that small intersection of things that might just about be doable, but still are transformational. And, you know, Commissioner Albuquerque is not going to be surprised that I use this to advertise the work of my colleague Nicolas Véran, who has argued for a much stronger approach to supervisory integration. And what he argues basically is that there are actually ways we can integrate at the supervisory level while taking those political economic constraints into account. And the key idea is that you supervise, you integrate, you centralize decision-making power, but you decentralize operations. And you do not upset the current balance of capital market functions in the member states. So the comparative advantage of certain capital markets at the member state level in performing certain tasks should be preserved, but under a common structure. So CMU will never work, I'm sorry to use the old acronym, Capital Markets Union will never work if this is viewed as just another way of giving Paris more power at the expense of everyone else. And so we need to keep those, you know, what he calls locational neutrality. We need to keep the current capital markets as significant as they are now or more so, but they need to be part of a common strategy and of a common decision-making authority. That is the key idea, I think.
Thank you, Jeromin. I think it's what you just said, it's a great starting point for the second round of question, when I would like to go deeper into this dilemma, integration versus fragmentation. And I have some clues, some questions for each one of you, but feel freely to jump in, and if we're able to just to open the debate, that would be great. So national interests often block common solutions. I dare to say that, you know, saying national interests is just very often exaggerated. I don't think it's always, or in majority cases, national interests. Is just short-sightedness of member states, of people working at the ministries, agencies, who are afraid for their jobs, who, of course, everybody doesn't like a change, unless it happens to everybody else. So, and we often say that that's national interest. So, and there's not that much substance behind that. So, but nevertheless, is EU serious about political will for real capital market integration, or are we condemned for this slow progress, for these partial steps forever? Commissioner, what are the hard truths behind why member states still resist aligning national legal frameworks?
I would say that partly is what you mentioned. There is also a lot of vested interests across Europe. This integration of capital markets would also bring about a quite more vibrant competitive landscape. Not everyone across Europe is that willing to make it in a more competitive environment. So there are also vested interests and lobbies and people that are very, very comfortable in the position they have built for themselves. So yes, all those factors are at play. And I think that there is a bit of a misconception of what sovereignty means. Because sovereignty is not closing yourself and having your stock exchange and your supervisor and everything at national level if it doesn't work from an economic perspective, because then sovereignty becomes a bit of an illusion. We need competitiveness, we need economic growth to truly be sovereign. So it's about finding the right balance. And this is not a power grab by the Commission, and I do know the proposals from Nicolas Véran, and I think that when, because we've been discussing this topic for many years, I think that when we put out our proposals for supervision, people will actually realize that this tries to be a balanced approach where we try to guarantee convergent supervision, but also allowing for some things to remain local, because I actually believe it is more efficient. It's not just a question of persuading the different stakeholders. I don't think that we would manage appropriately from the center. I am one of those people who believe that an SEC model in Europe would simply not work. So, and this is about making people understand that what is good for Europe is good for the different member states. It takes political courage, yes, because national interests are often powerful. So politicians will have to be brave and talk to the people and explain why this solution is better for the citizens and for the businesses. Some may lose out, some market participants, but that's how things evolve. Because if we try to maintain the status quo, we will all lose. And you were asking if we are condemned to do this slow progress. I don't think we can afford slow anymore. We don't have the luxury of time. The rest of the world is moving ever faster. So we have to do a lot. And on top of that, we have to do much faster than we usually do. Otherwise, we will not be able to recover the gap that we have allowed to grow. So it is about determination, it's about political courage, it's about making a clear distinction between what is the common interest and the specific interests that may be against it. And try to tell them both apart and then build solutions that can lead to reasonable outcomes. And to be completely clear, nothing in the SIU project is a power grab from the Commission at all. I just want this to work because I think in Europe we have it all as long as we get our act together. And that requires everyone to cooperate, every single stakeholder, and obviously national governments are key to this, but also parliaments across the EU and the European Parliament. We need everyone to be on board.
Marko, what has been Croatia's hardest integration challenge since joining Euro area?
Since joining Euro area, well, first of all, happened recently, but I can tell you that in terms of communication for me as a Minister of Finance and colleagues in the ministry, it was hard to explain and to make these long-term benefits visible to population. So whenever we talked about adopting euro as a common currency, there were always challenges in this respect in terms of administrative costs, in terms of transforming the economy legislation, making those double price displays for a while, confusion when it comes to consumers and consumer protection in general. So it was quite a challenge, and this was visible to the general public because they noticed prices in supermarkets. They saw something is wrong, something is different than before. They noticed that their salary changed, that their pension changed, the amount of pension changed, and it looked, in a way, smaller than before, because the exchange rate was 7.5 kunas per 1 euro. So it looked different when they received those bills. And then for the benefits, it was something vague. We were talking about eliminating the currency risk, eliminating the credit risk. We were talking about benefits in terms of borrowing costs. And this is something that is really long-term and hard to explain to the general public. So when you say that we eliminated the currency risk from our public debt portfolio and that our credit rating will rise, and it actually has risen for 2 notches in a couple of months, they say, okay, why do we need credit rating? Am I going to have a higher salary now? And we say, yeah, it does not directly influence your salary, but if you want to take a loan, you'll feel different borrowing costs. And then at that time, borrowing costs started to rise in general. So they said, but you promised once we introduce euro, we are going to have lower interest rates. And I said, yeah, this is because the interest rates would be even higher if we didn't change to euro. So you can assume how difficult it was and how, in terms of forming this whole narrative, how strict you have to be in defining what you are saying, not to end up in this trap of saying something different than what the reality shows. But all the stakeholders from the private sectors, speaking about firms, institutions in financial markets, they were all in favor. They understood the consequences very well. They understood all the benefits. They were all looking forward for this to happen. And I can say that we got a lot of support from this sector. So in terms of the financial markets in general, and then also access to finance and the risk that has been eliminated, talking about the currency risk, this really was a significant step and also an increase in our credit rating. When it comes to capital markets, this is also something that is quite important for us. As you know, our markets in Southeastern Europe are really small and fragmented, so we really miss scale. We miss liquidity in all our markets. And this is why I think this regional initiative that you also mentioned in your first question is quite important for us, because it shows that things do not have to be sorted out from only top-down approach, but they can also be complemented by bottom-up approach. And this is something that we are doing with this initiative. So getting together and talking about 8 countries, so Slovenia, Slovakia, Romania, Bulgaria, Montenegro, not Macedonia, Hungary, Croatia, Poland. So really a lot of countries from Adriatic to Baltic Sea that understood the importance of this initiative and readiness to work together is really a significant step in this sense. So we are not talking about competing initiative here, and this is what everybody understands. We are really talking about complementary initiatives. So if we are to align on EU level, and if we successfully align, the 7 countries of EU that we have mentioned, plus North Macedonia, then it wouldn't be 27 countries to align at EU level, but 20. And this is already a significant step. So I think this is really, really important. And I would also like to thank you, Klemen, for your generous support and the discussions that we had in terms of regional integration. You were the first one that I was discussing this with. So once you decided to move on with it, we discussed with other member states of this regional initiative. And I really think that keeping national specifics, but really seeing national stock exchanges as entry points to the regional market that has more liquidity, that provides greater visibility to our companies, that would probably also influence the valuation of our firms that are being on a stock exchange, but also provided greater access to capital, diversification, and also as one of the ambitious developing this common stock exchange index for our market in general would be much appreciated and would bring very visible benefits and progress very soon. Thanks.
Jürgen, is the Capital Markets Union designed with smaller member states in mind, or does it mainly serve big financial centers?
They, of course, have to be designed more in the way that those who make the game are involved actively. That means big countries. They have much more to benefit in the amount, but in relative terms, Estonia and other small countries can win even more. I remember the situation when I was finance minister first time during I became it during the debt crisis. We described European capital market quite similarly. We are describing it today. And a couple of years later, we were colleagues with Maria as well as finance ministers, became colleagues. So we can say that there are certain political and economic interests that slow the integration down in this area, and there is no easy solution for this. Estonia in itself, of course, is very dependent on breaking barriers in different ways, in regulations, in harmonization, in cooperation. We always have had to overcome shortages of our let's say, of being very small. It has been an issue in different areas besides economy. Recently, we have noticed Europe has defined common interests much better in security, for example. But this fight has been fought by us for much longer to understand where is the real enemy, where is the real threat. It took time. I became Minister of Defense in 2005 and had to convince NATO members that they should all start to increase defense expenditure, and then Putin became very honest 2 years later, 2007. But talking about capital markets, Estonian interest really is to have bigger unified market until bigger countries are a little bit resistant, I would say. We have been building up regional cooperation quicker. That is, we have harmonized our stock markets and stock exchange and depository with the Nordic Baltic region. Already historically, our banking is very Scandinavian oriented, and in the case of Estonia, very much defended from let's say debt crisis. We didn't have to save our banks, and this also has a sign of a little better, let's say, financial crisis, financial culture than in many other countries which are more prosperous. What else? It's more or less, I think, has been said. Thank you.
Jeromin, how can the EU overcome its tendency to over-regulate while under-delivering on the broader ecosystem for investments?
Wow, so you saved the hardest question for me. All right, so I think to create a good environment for investment, we have to go down the single market route, and the most important areas are savings and investment union and energy, in my view. And then there's one that is in a sense new and hot, but I think needs much more attention, which is single market with respect to defense industry and defense procurement, because we need to make rearmament much more affordable and create much more competition. We cannot stay in these national defense silos. So that's maybe not primarily about investment, but let's all think about the fact that part of the reason why we have a hard time with our economics is because we are so defense dependent. This is why we did not get the type of trade deal that we would have wanted. So I think defense is important even in this context. And now, as far as avoiding over-regulation, so my preference would be to go back to attempting to be thoughtful about regulation instead, in the sense of developing it carefully in a way that trades off costs and benefits. And we did have institutional improvements over the last 10 years that went into this direction. There was a thing called better regulation as an initiative. But we tend to kind of get carried away in both directions. So we got carried away because we wanted to push certain policy areas, new areas, very fast, related to climate, environmental protection, data protection, all good things, but we maybe did not reflect the unintended consequences enough. Now I'm a little worried we might be going down the other extreme, which is to suspend regulation in a way that is not really that well based on cost-benefit trade-offs, rather than reforming it. And so here, I think we have to go back and just do our homework on regulation and be more careful about it.
Yes, of course, Commissioner.
Thank you, Klemen. Just allow me just to step in on this over-regulation issue, because I think that there is, even the way we speak, the over-regulation from the EU. Well, the EU is all of us. The Commission makes the proposal, the ministers have to discuss and approve, and the European Parliament, which each of you elect, also have to agree and participate. So the EU is not the Brussels bubble. It's all of us together. And I think it is important to make this point. I'm sure you all know, but the way we speak actually gives the impression that Brussels is dictating the rules. The Commission can only propose. There are not so many competencies that we have that we can actually do on our own, and even that has to then be ratified by member states and by Parliament. So actually we have less power than it's often made believe. And yes, we tend to over-regulate and over-complicate. And the better regulation said there should be impact assessments. But the only one making the impact assessments is the Commission, because Parliament and Council propose tons of changes, and they never have impact assessments. And in the end, they say that the impact assessment made by the Commission doesn't actually, it was not well done. Well, it was on a different piece of legislation. Often what comes in as a Commission proposal and what comes out after the negotiation, it's a completely different thing. And we have to address this problem, and we all have to understand who is involved here and who is responsible for what. We want simpler, proportionate regulation. Then we have to start making our compromises in a completely different way. If we want to have there every single request, every single national specificity, every exception for everything, we will not get to something simple, and we often don't even remember anymore why we started that conversation. And this is not working. So when we sit down to negotiate, let's keep our eyes on the ball. Why are we doing this? What is the objective? And then make proper compromises, not minimum common denominators. Proper compromises. A proper compromise, we give in something to get to a better outcome, not having to see all our concerns being reflected there, because that is also the problem of why we over-regulate, because we don't do it well. The Commission, we are committed to do our share, but we need everyone else to chip in. And ministers, this is my appeal to you. Thank you.
Beyond integration, I think we have to face a hard truth. That is that Europe has been losing ground on its competitiveness. While we've spent years looking inward, debating, fine-tuning within our borders, US and Asia have surged ahead in a, I can say, ruthless global race. And we risk being overrun. So how can Europe not only catch up with the global leaders, but also position itself to lead, while, of course, maintaining sustainability goals and driving genuine innovation? Commissioner, given the pace of capital market integration or innovation globally, Europe falling behind, how do we catch up? How can we speed up? What is the big picture here in the EU?
Well, I'd say, and this is, I think, a very positive message about this project, about the SIU. First, we need to be credible again. When we say that we will integrate capital markets, let's face it, no one believes us anymore. We've been talking about this for a very long time, and it's not happening. So the first thing is regain that credibility. Start delivering. Because once we start delivering, expectations will help us. Because investors will want to position themselves. There's a lot of money out there looking for a home, wanting to come to Europe. So if they see the positive signals, it will come. And that will help starting improve the situation. So I think that as policymakers, as politicians, we have the obligation of start delivering. And then with all the other policies, and this, the Savings and Investments Union project is an horizontal enabler. I'm completely sector agnostic. I just want the money to be able to flow where there are good business cases. It's not in my portfolio to create such good business cases. That is someone else's responsibility. But I think that if we show that women business, and we do this for real, and we can agree on something meaningful and implement it quickly in a few months, then we will start regaining the credibility, which is key. And the rest of the policies will also find the necessary funding. We have to act in multiple other areas, but that is not my remit. But for this in particular, if we move fast and we make a few right decisions, that will immediately start providing positive results. And I think we can see that in the short term. And that obviously will help, because we will move from this conversation that we are a disaster lagging behind to we are actually recover and we can be on the lead. So it's also about the positive message and to get going.
Marko, how do smaller markets compete for the capital when global investors have bigger, more liquid options?
First of all, I think that there are several ways to do so. I think that smaller markets such as Slovenian, Croatian, we can be focused on certain sectors. So for example, in Croatia, the tourism is well developed. We are also focused on energy. We are focused on digitalization, decarbonization. Those are the priorities of our government in this third consecutive mandate of more or less the same government. I can say that I also think that the stability is important in our country. This is why I mentioned the thing about the government, because the political stability that we have and that makes also the environment friendly to potential investors is important. So we are not having sudden changes in the regulation that nobody can expect, but also the thing that we are managing other sectors, that we are managing public finances in a much better way than some other economies are doing. So we are basically in this respect, when we talk about fiscal stability, fiscal prudence, always lagging behind, and all of a sudden we are the front runners of fiscal stability, which I think it's really important and should be also marketed that way. But I really don't think that we should talk about competitiveness in this sense. So I wanted to give a flavor of what I think the specifics of local small markets are, but I think that we should not look at this agenda in terms of increasing the competitiveness and competing, small states against big states, or small markets versus big markets, or European markets versus Chinese markets, or Asian markets, or US markets. What bothers me is really the thing that we are having firms that have innovative potential that cannot realize this potential because they lack financing. They often have projects that are not bankable, and then at the same time we have, for example, in Croatia, 40 billion euros sitting in bank accounts at close to zero interest rates, and it's similar also for other countries in the region, but also for EU in general. So talking about competition, we have friends from Asia sitting here in the first row. It's not, which market is better and bigger. Is it Asian market, US market, Croatian market, European market? But it is really, trying to mobilize those savings that are essential for financing the things that we have on our agenda, and this is definitely decarbonization, digitalization, defense spending that the public sector cannot finance alone. Banks cannot finance these needs alone. So we had some estimates that for only a green and digital transition, we need around 800 billion euros annually to finish the agenda as we see it on the EU level. And this money has to come in from other sources, especially the capital markets that we are discussing for almost an hour now. What strikes me as European is that sometimes those firms that I was talking about in search of capital go to some other countries and they bring their talent there as well, and when they find financing, the talent stays there, and this is something that is that might be worrisome for EU in general, and this is why I think that capital markets integration is very important. So for small countries, for small markets, it's not trying to replicate, Paris or London or Frankfurt or something else. Of course. But we are really trying to make our markets stronger to be able to help European Union in general and EU markets to be even more stronger. So we definitely might not be the engines in this process, but we also don't want to be passengers only. Thanks.
Jürgen, what role do you see for fintech, tokenized assets and digital innovation in trying to leveling the playing field?
For sure, technology is our future already by definition, and certainly young generation is our future. And one of the reasons why technology has come to stay is that young people are very open to it, and already traditional financial sector has changed a lot because of this innovation. The other element for Estonia, very significant, of course, is venture capital. Risk capital investments are also generating a lot of innovation. We have seen it clearly in Estonia. But also I will now take a step back as well. Not being the youngest from the youngest generation, my instinct also haven't lied to me that about the risks. When I was first finance minister, excuse me for the history again, but I already was a little bit critical about the risks of money laundering and tax fraud that are connected with the new technologies, cyber assets, and so on. This all has happened actually. Estonia itself has made some mistakes. We have made crypto, cyber asset companies. We try to become a center of them in Tallinn. Most of those companies were registered in Tallinn, and suddenly we realized that we have to get rid of them. And we managed to do it already. There was more than 1,000 such companies. Now there is some tens, I think, left. And the number of them hopefully will decrease again, because supervision over them is quite complicated, and the risks are very high. But Europe has also changed here, and there are initiatives that have helped to tax them, for example. And of course, the project of digital euro is something where we can trust technology in advance. We know this is something honest. Yeah, thank you.
Jeromin, I'm back to you with a slightly similar question at the previous one. Where does the Europe risk losing competitiveness if we don't act now?
Okay, so probably two things come to mind. One is areas where technology is advancing very quickly, and we are at risk of getting left behind. And so, AI, maybe digital payments, these areas come very much to mind. And so here, it's a matter of creating an enabling environment that will allow our talent to rise and invest. And that involves also areas such as data protection, which we probably do need to revise. And then the other big area, I think, is there are some areas where we've already been subject to large competitiveness shocks, but we have not adjusted to them yet, or we are basically figuring out how to do it. And then depending on how we do it, it can't be a competitive disaster or not, right? And so this is essentially the area of things that are sensitive to high energy prices, where I think we are still a little unsure whether we manage this through, fast integration of policies and institutions in the energy area, accelerating green transition that could bring down prices, or whether we manage this by throwing subsidies at energy-intensive industry, and if so, what are the criteria? To what extent do we try and shelter these industries? So these are super difficult questions, and I'm a bit concerned that we are biased in the direction of protection, that we are in a sense, not promoting reallocation and restructuring enough, and by not doing that, we might be endangering the entire industry, as opposed to just shedding stages in the industry where we are clearly not competitive. So that is an open question where I also think the Draghi report did not completely get the balance right, and I'm very worried about the proliferation of state aid.
Thank you, all of you. We're at the closing round, so I have the same question for all of you. Please be short and quick. It's a simple question. Looking 5 to 10 years ahead, what do you see as the single biggest opportunity and the single biggest risk for European capital market? Commissioner.
Actually, I would like to make my concluding remarks using those two words you chose, opportunity and risk. I do think that for us to succeed, we have to consider taking risk as an opportunity. Because the problem has been, in my view, that we have also influenced by the great financial crisis, and we have our scars, and of what happened then, we focused too much on trying to eliminate risk. And by that, we eliminated opportunities. Because there is no way, actually, if we eliminate risk completely, we will have no innovation, we will have no growth. And that is true across the board. We should allow our retail investors to take some risk because they deserve to have higher returns. We should allow our companies to take some risk. Some of the innovations will not succeed. But if we don't try, and if we don't lose sometimes, we will never get the ones which are right. So there needs to be a better balance of how much risk we are willing to take. On data protection, if we probably have gone too far, actually we are addressing that. On the competition rules, probably they're also not fit for purpose for the future. It's about finding the right balance and also having politically a different approach to risk. I am not defending that Europe should take too many risks, like the US economy, for example, because they are way more flexible. They can afford to take more risks because when they go into a recession, they bounce up quite quickly. We don't. We take forever to go back to where we were. Also because we try to shelter everyone during the recession phase. So we are different, and that is fine. But we need, in my view, to allow for more risk into our system. Because without taking more risk, we will not have the opportunities that it brings and the growth that we need. So the biggest risk I would see is that we continue to be too focused on being protective. And if we overprotect, we will continue to lose ground, and it will come a point where it will be too late to recover. The greatest opportunity is actually shifting this mindset, thinking more European, taking more responsibility, and allowing in the appropriate levels more risk, and fostering a culture where people think, okay, I want to take risks because there is a lot to gain. And if I fail, I can find another opportunity. I think this is something that we really have to have in Europe, but this is a change of mindset. And this is a change of mindset that either we have it all or it won't work. And I don't think that we are either over-conservative or getting too old for that. I think there is time to do the right thing, and we really need a change of heart and look at the glass half full rather than looking at the glass half empty as we usually do in Europe. We spend too much time saying what we didn't manage to achieve and too little recognizing how far we have come and how big is the potential we have to transform our future.
Klemen, I was really enjoying listening to the conclusions of Madam Commissioners, so I fully agree. I think it's the best way to finish the panel, so I don't want to ruin it. If you allow, I'll skip last words. Thank you very much.
It would be not interesting to agree with everything that has been said. I am not sure taking risks is a purpose in itself. And I'm not taking the risk to make forecast where we will be within 5 years. Actually, the reason is the speed of development of technologies, first of all, if we mean financial sector only, and I think the mission of authorities is to control the risks, not to take them. Private sector is taking them anyway, and technology is giving us new risks we can't forecast, as I said already. But One more thing I would add to the biggest risk in 5 years perspective still is the traditional military war in Europe. Not technology yet, I believe. So let's win this war first and then talk more about other risks.
So I fully agree with Jürgen that this is indeed our biggest risk, but I'm going to frame it a little more narrowly, right? This was the biggest risk about the development of capital markets. I think that was the context and the biggest opportunity, and I think here, very clearly, the biggest opportunity is to have a breakthrough on banking union, because that's going to be the foundation for a breakthrough on capital markets. And by breakthrough on banking union, I mean proper safe asset that is actually in the bank balance sheets, meaning we will need some sort of inducement to get there. So breaking the doom loop, defragmenting sovereign debt markets. That would be the key thing that could really drive it. And it's been tried, we got stuck with it, but you gave me a 5 to 10 year horizon. So I'm very confident that at the end of Commissioner Albuquerque's mandate, we will have it. And I will measure her success by how close we are to getting there. So that would be transformative. And then the biggest risk for me is sort of the flip side of that. So it is rather easy to come up with crisis scenarios, probably originating outside the capital markets, right? The shock, so either originating with the fiscal or originating with geopolitics. And then the biggest risk is how we react to those, and whether we react in a nationalist way within Europe that then undoes the integration that we have had, right? So essentially supervisors cracking down on liquidity within their own borders, that sort of thing, right? Because we do have a great banking supervision unified in Europe. Our resolution framework is a little bit iffy, right? It's not really fully integrated. And so you can see a big shock happening, then, the wrong reaction to that shock throwing us back. That I would say is the biggest risk.
So, thank you all. I really enjoyed being your host, and I think it was the wonderful beginning of today's conference, and looking forward to hear the views from the other parts of the world, the other parts which Europe can learn something on their development and how they tackle the question of the capital market. So thank you all, and let's enjoy after the coffee break. Oh, okay, sir. Sorry that I'm taking your role as well. So thank you all.
So thank you, everybody. Like we heard, do you hear me? The Commissioner, we heard you well. There is a lot of money looking for home. We hope it finds it in Europe.